Money FM 89.3.
So Money FM 89.3.
Listening to Money FM 89.3.
Singapore's most influential radio station.
This is Prime Time on Money FM 89.3.
Time for Career 360.
You're listening to #Wanderlust here on Lunchtime. I'm Timothy Go.
Welcome to Weekend Mornings here on Money FM. Glenn Van Zutphen with you.
Good morning. It's the Breakfast Huddle.
Money FM 89.3. You are indeed in the Breakfast Huddle with me, Manisha Tank.
You're in Money and Me. I'm Michelle Martin.
About a month away from the announcement of Singapore's budget this year.
What drives your passion on the issue of mental health?
Tuesday was a good day for market.
Will the UK still be part of the EU?
So how are careers being disrupted today? That's hopefully something we'll address.
Welcome to Art of the Deal.
We're at the Mercedes-Benz Center for our second edition of Money at Work.
Money FM 89.3.
All right. Good evening, everybody. Welcome to Money Matters. I'd like to start off by thanking everyone for taking some time out of your Friday schedule to join us today on Money Matters. If you are a listener, whether you're avid or casual listener of Money FM 89.3, perhaps you hear us say this, you hear this disclaimer every so often before you act on the information you hear or read on Money FM 89.3. Remember to consider it if it is suitable for your own investment objectives and financial situation. Well, that's the deal, right? And that's the gist at the moment. How do we know if something is suitable for our own investment objectives and financial situation? What we hear on the markets, how does this translate into our goals? And can we find something within these broad instruments and possible investment avenues to help support us with regards to our long-term investment objectives? And I think this is why the producers of Money FM 89.3 decided to come up with Money Matters to help our listeners actually get a better understanding and a more on-the-ground understanding of how to approach the markets and perhaps get more ideas to how they can make sure that it's aligned and attuned to your investment objectives. I'm JP Ong from Primetime, the finance presenter. I just came off of work just about 45 minutes ago, but then money doesn't sleep. Investments, markets don't really sleep, and we're very honored to be here with most of you folks. I would like to bring out today also Mr. Geoff Howie from the SGX. He's a strategist for the SGX, and he's also a regular on our Friday show on Market View with Clarissa Montero also. This is actually the third episode of Money Matters. There were previous episodes in the last couple of weeks, one of which was with Michelle Martin, Gabriel Yap, when they shared about how you can actually build a respectable and an effective S-REITs portfolio in this particular year, especially this very unique year of 2020. The second episode was when Ryan Huang, my counterpart in the Breakfast Huddle, spoke with SG Budget Babe Don Sher about possibly creating a portfolio and investment for your children and making sure that they can at least get on the right track at least with regards to investing, because this is a skill that not many people teach their children and maybe cannot teach their children. Well, today we are going to talk more about the stock market, really getting down to the nitty-gritty and the simple and some of the basics of the stock market, understanding how this can actually help you with your investment decisions, and also get ideas of how to approach the stock market in these very, very extraordinary COVID-19 times, and also to understand how you can better approach it, and perhaps just what steps you can take to make sure that your execution and your first steps into the market, if they are your first steps, are efficient and also as pain-free as possible. Without further ado, I would like to bring in Geoff Howie of the SGX again. As I mentioned, he is a market strategist for the SGX. We did just speak to him. I myself just spoke to him earlier today on Market View, and we had a very interesting discussion actually about how well stocks have performed in the last couple of weeks, in spite of all of this uncertainty. I tend to take, and Geoff, I'd like to at least take a stab at defining who we are in the show. I tend to take a bit of a more realistic or a more skeptical look at markets sometimes, and it seems that you always tend to find like a certain ray of sunshine in every little story, no matter how bleak or dark it is. Also bring us back down to earth, which is I'm very glad that you've taken some time out of your Friday to join us today. And I know that you've got a lot to share actually with some of our listeners before we and our viewers today. Forget we're on video now. Our viewers today. Before we start, I do want to highlight that there is a comment box on the right side of your screen, and feel free to type your questions there. We do have some producers on hand who are willing to collate and collect some of these questions to make sure that Geoff and I are answering your questions, are engaging with you, and making sure that the presentation itself is also very engaging and relevant to some of your questions. Whether you are new to the stock market or just looking for ways to perhaps polish up and perhaps approach some of, perhaps build on some of the experiences you have in the stock market, Geoff and I are here to speak about it. Well, actually, more Geoff. I do lean on his expertise a lot, to be honest. And I'm very, very honored that Geoff's here and to join us. Geoff, without further ado, I mean, I'd love to just hear what you had to think. And, we do talk about how markets this year have gone through such an extraordinary time where they've pulled back. We saw that, I call it a meltdown. Some might say it's a little too dramatic, but a first quarter meltdown that many stock markets have done a lot in terms of trying to recover and recoup, whether it's because they're getting a boost from monetary stimulus or whether it's because retail investors are just finding it too cheap to ignore them and to try to build positions. It's been very interesting to look at markets, both in terms of how they're moving, how they're being valued, and how investors are executing in these very extraordinary times. This is just me basically trying to set the proverbial table for you. But yeah, sure. I'd love to hear some of your thoughts on that and perhaps help us get deeper into understanding the stock market based on that set of cutlery that we have.
So we've had our stock market moves this year, which have been very measured. Actually, a lot of them have made a lot of sense and reacted to the COVID-19 and the economic lockdowns and the entire ramification on businesses across the world has been very similar. So depending on what industry you're in, you've seen a lot of convergence in the same economic challenges. Whether you're in the transportation, whether you're in finance, whether you're in the co-location, the data centers, or whether you're producing medical devices and medical supplies, I guess there's been a lot of convergence at a sector level for all these businesses. So, in a way, that's almost textbook in what happens in a big pandemic when we're all synchronized in terms of the economic challenges that we're facing. And I guess so. You've had a market that I think in many ways has made sense. And we're not just going to look at the stock market. We're going to look at, as our CEO likes to say, we're a multi-asset exchange. We don't just have stocks here. We have a lot of ETFs, a lot of products, derivatives, and most importantly, a lot of stocks in a lot of very different businesses. So there have been a lot of diversified returns in the year at various important parts of the year as well that we can cover. So we can talk about this vibrant market that we have. But I do have to qualify. There's two ways that I guess individuals or institutions have dealt with it. There's the investing side of it, and there's the trading side of it. There have been two clear, distinct methods for participation in our market this year: the investing and the trading. I mean, rule one of investing, and I think Tannoy Boone said this on the 19th of July in his 6 Rules for Investing in the Sunday Invest, which is a really great read. If anyone's listening here and hasn't read it yet, do check it out. I think the first rule, of course, was don't try and time the market. And that's so true for investing. But for trading, that's what traders are basically doing. And we've seen a lot of trading this year in those sectors that have been particularly prevalent in the market because of the less adverse impact that COVID-19 has had on their operations. Obviously, technology stocks, particularly in the technology sector, it's data centers, it's co-location, it's anything to do with the internet and cloud streaming. And then, of course, in the healthcare sector, you've also got the medical supplies and the medical devices. and some of the biotech stocks also really bringing that sector to life as well. So that's pretty much what we've got in place. It doesn't mean investors are going in and buying and holding these medical stocks or these tech stocks, but there's been enough, I guess, interest across the world in the industry to bring a level of turnover that we haven't seen for some time in these specific sectors that has enabled investors to take or to move into more of the short-term trading opportunities with those types of stocks.
So, Jeff, here's my question. It's very interesting you said that if you're trying to get into the market, and maybe you've already set rule number one here, and correct me if I'm wrong, you've said that we shouldn't try to time the markets if we are investors. So in that case, if people are new to the markets, should they even worry about entry points at this moment, try to worry about some of these things, or is it just maybe just cautiously and prudently getting your feet wet and just start setting something up already if you're trying to get into the markets?
Well, what we have seen more, I guess, dollar cost averaging has for new investors has become somewhat of a trend. And in dollar cost averaging, you don't try and time the market. In fact, you do the opposite. You try and take out the timing risk, because you effectively commit a set amount of dollars to a particular stock or a particular ETF that covers a wide range of stocks, and then you commit that certain amount of dollars every single month or every single quarter or every single year to that actual market. And that means if the price is say at $5 and you're committing $100, you're going to end up buying 20 units. But if the price goes up to $10 the next year, you're only going to be buying 10 units. So you end up buying more at market lows, less at market highs, and you also take out timing risk to an extent. But
okay.
but more, and that's a long-term type of investment that, what way of trading that basically you don't put your eggs in one basket in terms of the timing. You don't use the big risk is market risk. Obviously, you don't want to go in and buy near market highs. You want to kind of mitigate against that risk as much as possible, and hence you don't go all in. When you set that trade up, that is a typical behavior, not just here but across the world. But we have seen here that investors are in the market because we've seen a lot more adding to positions across the market weakness, particularly in the month of March and April and so forth. We saw, particularly in the exchange traded funds that cover the Straits Times Index or the bond indexes here in Singapore as well. Those ETFs, they crossed AUMs of 1 billion Singapore dollars for the first time since they were listed, in the mid 2000s. So you've got investors adding to the positions in the weakness in those ETFs, and it's interesting too. When you look at the makeup of the AUM of, let's say, these ETFs that cover three key asset classes: the Singapore bond indices, the Singapore Straits Times Index, and gold. If you look at from the retail perspective, going into this year, the retail AUM for the, 5 ETFs that cover those three asset classes, you were 15% bonds, you were 65% STI, and you were 20% gold. And then as of now, that's come off somewhat. Bonds have come down from 15 to 10%, but there's been a top up into the STI. So STI is now 70% of the AUM. Or the AUMs have been growing, but particularly for Straits Times Index and particularly for gold. So Singapore retail AUM in gold is when you're comparing it to the classic stocks, bonds, stock bonds and gold actually does make up a decent part of it. If you look at the AUM as a whole, so you look at these 5 ETFs and you look at the retail plus the institutional AUM, that's a little bit of a different story. That's a little bit more balanced, if you will, a little bit more closer to 1/3 gold, 1/3 bonds, and 1/3 STI, somewhat. And you know what? If you had followed that methodology, it's a little bit different to the old 60-40 rule. If you were 15% those Singapore bond ETFs, 65% the STI ETF, 20% gold, as the retail AUM in the gold market was last year, you made 10%. And if you had tweaked it to be 10% bonds, 70% STI, 20% gold over the first 7 months of this year, you're down around 7%. So not a big loss. And that, I guess those returns, they do seem pretty muted compared to what you are reporting to in Money FM in your daily wrap. But again, this is a passive investing. So this is the investing part of it. Passive investing using ETFs. I guess there's an element of diversification, and there's been a little bit more of an element of the timing has come in that we have seen investors top up those positions amidst the market weakness, suggesting investors had been holding those positions before and obviously taking advantage of the market weakness to top those exposures up.
Interesting. All right. So, let's I think some of the questions here, and I'm looking at one question from Audrey at the moment, and I think there's a question within her question as well. I mean, the question is really that if we're expecting another big crash soon, or if the market is already starting to bounce up. I think it's all should we brace ourselves for extended volatility, perhaps? Maybe, and I don't blame. Maybe traumatized is too hard a word, but February and March, that tumble was very, very drastic and stark, and I think people are trying to protect themselves from that a bit as well, Geoff. So I think on one hand, we're trying to figure out, well, is the worst over? Are we starting to see some stability starting to return, at least to the markets? I know liquidity starting to support that. Or should we perhaps prepare ourselves for something approaching what happened in March? I will say too that when you do invest, I believe you also have to get used to start to see your stocks come out. Like for instance, a Wilmar International, just because one of their investors, we talked about this earlier this afternoon. Somebody just said, I need some cash. I need to take profit on a position, and it just sent the market stock down. And today, it just started to show signs of creeping back up, right? So these things are part and parcel, but I think better understanding or better trying to at least anticipate a possible downturn is something that's on everyone's mind in the pandemic as well.
Yeah, there's actually a slide that we could bring up.
Geoff is reloading at the moment. Yeah.
Okay.
All right. So Geoff, go ahead.
Yeah. Okay. So yeah. To Audrey's question, if you want to take a step back to March, STI 10-day volatility reached as high as 80%, 80%. It's got as high as 34% in June, but for the month of July, it was in the low teens. It was quite muted.
When was the last time it was 80%, that high, Geoff? Would you say GFC time? Like
yeah.
Kind of yeah. Okay.
Yeah, totally. But a lot of the big upset that occurred in March was mostly to do with the US dollar, the world's global the world's global reserve currency, the big safe haven per se. That was a really, really tough time. In fact, the 10-day volatility of the US dollar reached as high as 22.5%. Now, that might not seem like a lot, but that is the reserve currency of the world moving on an annualized basis 22, 23%. So that's only happened 5 days. It's only been that as high as that or higher than that 5 days in the year, all the years since 1986. So we actually moved to a precipice. And you'll remember MAS set up liquidity swap lines with US dollar. We did a lot. The Fed Reserve moved very, very quickly to shore up the liquidity in the US dollars and to get, I guess, those money rates and bond rates back to more conducive levels to doing business. But effectively, the US dollar that really drove the problems in March, and then ever since then we have had very stable US Treasuries. US Treasuries have been in a very narrow band from 0.8% to 0.55% since then, and then at the same time you've got the price of gold continuing to rise, up around 40% so far in the year to date, being the safe haven commodity. And then you've also got crude oil, which continues to fall, and the divide or the price ratio between Brent crude oil or WTI crude oil and gold is at an outlier level as well, because you've seen crude, which representing global demand, fall so much, and gold at the same time move up somewhat. But all in all, I think the market is on edge because we could have more volatility. Because you think about you go back to SARS. It's interesting in that back in 2003, when you look at the cycle high of the STI down to the low of 2003 when SARS hit, you had a 35% decline. I think it was way back from the 5th of March 2002 down to the 11th of March 2003 low, which was around 1200 thereabouts, and that was a 35% fall. And we had a 35% fall this year as well from our preceding big high down to the 23rd of March low. But you go back to the GFC, there was even more volatility. We saw the STI decline 63%, I think, from October 07 through to March 09, before it had that long 127% recovery. So traders and investors, they're not throwing caution to the wind, because we've had this volatility just very recently, but at the same time, it's all those ECGs, if you will, they've come into much more normal levels. But the caveat is that we're continuing to see more participation in gold. So turnover in the price of gold, it was in the gold ETF on SGX this year has tripled in turnover from last year, but the price is up 40%. So that's showing you that there's a lot more investors going in and using gold as a hedge. And you basically also have a divide between the way the markets are working. So the big risk is that obviously much more resurgence of COVID. COVID's it's every month it's getting more and more. Remember, at the end of June, for the first 6 months of this year, we had 10 million cases and we had a 4.9% mortality rate. And you look at the report this morning, we've gone from 10 million cases at the end of June to 22 million cases today, albeit the mortality rates come down from 4.9% to 3.5%, obviously with more testing. But nonetheless, you do have these clear divides in the market. You have tech stocks and healthcare stocks that are basically moving, have the beta where they are actually moving higher amidst the COVID challenges. And then you have the real economy stocks, the transportation, the finance, the industrials, the real estate developers and so forth. They are the laggards in view of what the implications and the problems with the economic containment. So in many ways, if there is more volatility to come, there's and it's COVID driven, then there's ways to obviously deal with it in your portfolios. And also, if you do see, if the concern is you're going to have this level of indiscriminate selling that we saw in March, and particularly in that third week of March, then of course you've got hedging abilities too. There's a number of products that SGX provide that enable investors to also hedge their positions and hedge their bank's exposure and so forth. So it's just reading the signs and seeing when one of the alternative, I guess, scenarios are that we beat COVID, but then we can't get our economy started again. And I'm not talking here in Singapore; I'm talking across the globe, because we're all facing the same challenges. But nevertheless, there are a number of scenarios. So if you are concerned about more volatility, there's products to hedge your exposures, but for the meantime, it's as we've said, it's a little bit of a tale of three cities: technology, healthcare, and the rest of the sectors. But here in Singapore too, I should note that we actually have had quite a pullback actually from the STI got up to 28.39 on the 9th of June, and it's since pulled back 10%. It's since pulled back 10% from there. But resilient Singapore is doing okay in terms of your F&B. You've got Kofu Group, which is up 2%, while the STI is down 10%. You've got Jumbo Group, which has a revenue stream in China. I think maybe 1/5 of its revenue comes from China. Jumbo Group is up more than 20%, and then Kimley's up 8% from that 9th of June. So there's elements of resilience in the market, but nonetheless, some of those big sectors, it's really hard to beat the global trends. For instance, the banks. Banks are down, between 15% and 20%. Globally, the big banks are also down 15 to 20%. We're facing the same challenges for many of these sectors, and that's seeing very convergent returns of our sectors in Singapore with the different sectors in the US. For instance, finance sectors in Singapore working and reacting very similar to finance sectors across Southeast Asia as well as in the US.
All right. It's interesting you bring up gold as well there, Geoff. I guess you answered in some sense Kan Kumwa's a question about whether it's still okay to buy gold now based on current pricing. Going back to that tenet also, I mean, if gold is meant to be a decent hedge, should folks be worrying about the price at this point if they're just trying to get it in as a practical hedge component in their portfolios, or should they just go ahead and just take it?
Well, it's interesting because World Gold Council always recommends somewhere between 2 and 10% of portfolios should be in gold. Ultimately, the driver of gold is fear, and gold is one of the most uncorrelated assets to anything. It's very uncorrelated to the STI. It's very uncorrelated to the S&P 500. So there's no sort of, because the STI goes up 9% like it did last year, gold doesn't go down 9%. In fact, gold was up 17% last year. So it has its intrinsic, its clear intrinsic driver of being the safe haven, and enabling investors to minimize their risk in their portfolio. But it's again calling whether the price is too high and so forth. That's a very tough one to do, because you're ultimately making a call on every other index, saying, okay, if gold's coming down, it means all the other indices are going up. So it's a big call, and the only if a vaccine comes in and we make a very swift economic recovery, that could be a scenario. But we have to watch the developments, both the economic developments, of course, and of course the race to beat this COVID-19.
Yeah, it's interesting too that with regards to gold, and this goes back to your point about liquidity there, Geoff. Well, one thing that might threaten gold, as it did sometime in this early second quarter, if you recall, there was also this uptick in gold that started to wobble a bit, because folks were trying to find places to shore up capital liquidity, and the only place they could really tap that liquidity in was gold. And gold was starting to get a little hamstrung because they were waiting on more stimulus from some of these officials, fiscal, monetary as well. And when taps were suddenly open, you started to see gold prices start to stabilize. It wasn't because gold lost its shine as a safe haven, but when you need to cover positions, there is a chance that you're going to have to look at some of your best performers or even your safe havens and you might just have to put your hands up and say, well, I guess I have to just bite the bullet, take a bit out of gold, but that could send gold prices back down. So gold, in some sense, I mean, while there's uncertainty, there is a chance that there's going to be a trajectory up, but it's not it's not a smooth. And you've probably been watching gold a little longer than I have, Geoff. But my impression of gold is it's never a smooth trajectory up because you're going to have these checkpoints where people will go, well, we have to wait for a little bit more liquidity might come back, which might send it back down. It's kind of like 2-3 steps back in some sense for gold at certain times. Yeah.
And that's exactly why you see investors spreading it out and not trying to time that investment per se. So we've got an ETF here that's been listed for some time. I think it was October 2006. It was October 2006. It's been listed. It listed earlier. The same ETF listed in the US in November 2004. And from November 2004 through to the end of July, that ETF's generated annualized returns of 8%. But it hasn't been obviously a smooth ride, 8% every single year. So it's an investment that has that long-term return. But it has seen a lot of net inflows this year. I think of around $16 billion in the first half of this year. That's $16 billion US dollars, bringing the global AUM up to 67 billion. So you're right. There was quite a strong rotation into gold. From a policy perspective, the world's now getting to the stage where we've just got to really do the work. We've got to do the hard work, and we really got to knuckle down on jobs. We've got our job support scheme here. You've got this is going to be the big economic policy going forward. It's playing the long game with COVID-19 while we wait for the vaccine. At the same time, maximising every opportunity to upskill workers and find new products, new markets, new ways of doing things, and really, I guess, trying to focus on labour policies labour market policies to boost employment. It's and that's going to take time.
Yeah,
it will take time.
Yeah, absolutely. Geoff, it's been very fascinating. I fear that I might have taken you astray because I know you have a bunch of slides you wanted to show some of the listeners.
No, you're
as well.
right. It's okay.
I'd like to get you back on track if ever. Yeah, but it's been very interesting. Just want to make sure that we didn't neglect your slides. I know you worked very hard on them as well. So
no, not at all. Not at all. No, that's fine. So we've, so you've got the key thing is that markets have moved this year in a very measured way. In that the S&P 500 is in positive territory this year. It's no longer in the red; it's in the green. As the FTSE All World Index is too. But the key thing is those two indices. 40% of the weighting of those two indices is made up of tech stocks and healthcare stocks, and they have been particularly strong. What we don't have in the STI is a strong presence of tech stocks. We have one tech stock, which is Venture Corporation, but if you look beyond the STI and you look at the 100 biggest traded stocks by turnover this year, you've got almost a dozen healthcare stocks in there. You've got probably 10 or so tech stocks. So there is a great deal of activity in our broader market outside the STI for investors that look outside the benchmark. Basically, a lot of the trading activity we see on a day-to-day basis. I guess our key tech stocks, Venture Corporation, it's up around 30%. No, it's not. It's up. Yeah, it is up 30% in the year to date. Maple Tree Industrial
Just about,
Trust.
yeah.
Yep. Yeah, you know because you read these out every day. Maple Tree, and I write them. I think if you read them out there, you probably remember more.
Yeah. I just copy off of what you write, Geoff. Yeah, I'll be the first to admit. But go ahead.
AEM Holdings is up 100%. You've got Keppel Data Center REIT up 44%. That actually puts Keppel DC REIT in the top 20 REITs of 2020 so far. So there's around a little over 800 REITs listed all across the world. Obviously, lots in the US, lots in Japan, and then look at the top 20 performers. That's our biggest STI reserve list stock, Keppel Data Center REIT, the first Asian pure play data center REIT to list here in Singapore Exchange. More passive, I guess, tech returns has been Netleak NBN Trust, which is up around 5% in the year to date. And then UMS is also pretty flat. But, when you're looking at those 50 top stocks, you've also got Medtex International in there. You've got Riverstone Holdings, UG Healthcare, and Top Glove is just outside the top 50 by turnover as well. That's averaging $4 million in turnover a day. And obviously the stock price has been really strong, up 400%, more than 400%.
What is Medtex? What is Medtex again, Geoff? 5,000% up since the start of the year? Is that
Yep. 4,000,
yeah, right?
4,900.
And I mean, this is something it's but just it's been very, very just how well we done and we continue to rise up. But I think there's something similar that these healthcare stocks, these glove makers, these PPE guys like Medtex, for instance, might have in common with some of the tech stocks we're seeing in the US. There doesn't seem to be anything that can really stop them from moving up, bar the odd day of profit taking, right? But is it getting a little too frothy? And when you're an investor looking at stocks and you see these sectors or these groups of stocks, like say your Teslas, your Facebooks, your Apples, or in our case the Medtex, the Riverstone guys, and they start to move up at that pace. I mean, how would you advise an investor to approach that particular sector, and what are some of the things they might have to keep in mind? Because the tendency might be to say, oh, I have to get on the train before I miss out sometimes, right? But you might be getting these stocks at very expensive price points that might just wipe out whatever allocations you have, right? So
Oyboon's second rule: invest only what you can afford to lose. And importantly, I think the third one was don't go with the herd. So there's obviously the I guess the much stronger turnover in the stocks, the interest, the performance, and so forth. But I think investors, it doesn't seem to be the activity on a day-to-day basis. It looks to be there's enough variability, enough range in these stocks that we're seeing investors don't have to hold the stocks for a long time. They're not. There doesn't seem to be a lot of buy and hold activity when you look at the activity on a day-to-day basis, because there is high. And if investors are holding and taking a more short-term trading mentality, then you're going to expect more turnover because they're completing the trade. That's twice the turnover you would normally do if you're going in and just buying in and holding it for a long period of time. So you do expect to see more turnover when stocks are being traded on a short-term basis, entered into, and as well as exited out of. And we've seen enough swings just in the month of August, as we talked on the program today, JP. The COVID-related stocks, everything from the price of gold to the rubber glove manufacturers and distributors, have already had some significant swings, and that provides a tradable market for many. More of the traders, less of the investors that are looking for more short-term activity. But again, of course, you don't. For trading, most traders have to always, you always have to read do your homework on your risk management and your money management and so forth, and make sure that you're not over trading your account and so forth, and not wasting, not wasting, but putting too much money to work. The good old money management rules, if I remember right, is that you set aside 10% of your investment income, and you use that to trade, and then depending on how much money that is, investors will then work out risk management rules. So you don't just work out when you enter the stock. You know when you're getting out of that stock, when you reach your target, or when it doesn't move as anticipated, and you take your stop loss. So trading per se is very different to buy and hold. But there's enough swings and enough variability on a week-to-week basis in these stocks that it can attract the short-term traders. But then if you're an investor, this is something you need to do some homework about first.
there's a lot more trading activity versus investing. I think that's what I caught from you, Geoff. Is that a good thing or a bad thing? Or is that not necessarily a bad thing when you see more short-term trades happening, day trading, and dare I even say maybe some speculative trading out there? Is that necessarily a bad thing when you see a lot of that activity in the markets?
No, I mean, for sophisticated, experienced investors that know what they're doing, it's a good thing.
Okay.
It's if it's an investor that is unsure, and it's it's. I will go back to that article, Tannoy Boone's article on 9th of July. He did make the point. You don't just show up to a check-in desk with $10,000 ready to go for a mystery trip, without knowing anything about where you're going. You know what I mean? So the good thing is, we've got our SGX Academy that I will mention that runs a lot of courses in terms of empowerment as an investor, all the way to trading derivatives, in terms of looking after investors that have from very little knowledge to working in the industry to having a good understanding of real estate and dealing in real estate to having an investment portfolio but looking to trade. We have a number of courses, a number of qualified instructors that we really treasure, because this academy does get to be on the forefront and be able to work through and guide many investors and aspiring traders on what to look out for and what the risks are. And obviously the big risk for any trader is market risk, moving against you. It could be liquidity risk in some instances, because you choose to trade a stock that isn't so traded, isn't so popular. We teach investors about all these risks and how best to mitigate it and so forth at the academy. So if there's any viewers tonight that aren't aware of the courses and the materials at the SGX Academy, please don't hesitate to reach out and ask us.
Absolutely. So I guess we can just go on with some of your slides, Geoff, and there are a couple of thematic questions in the comment box, but I do want you to build a little bit more foundation before we tackle some of the more specific ones that some of the other listeners have actually thrown at us.
Yeah. Okay. So I think the second slide, the next one, the big global stock market moves in 2020, that kind of shows pretty much what that story is. The blue bars represent the median returns of these sectors, and this is the top quartile of stocks. So we're looking at all the tech stocks in the world. We look at the top quartile or the top 25% by market value or market cap. Yeah, and you can see exactly there. You've got technology median gain 14%, healthcare median gain 11%, but the average gain's much stronger, up at 24%, up at 30%, because you've got a lot of outlier performances. Medtech's International Corporation is not the only outlier in the healthcare sector across the world. As you can imagine, that there's a number of stocks that have moved and therefore skewed up that return in the healthcare sector. The next best performer is non-cyclical consumer stocks, and that's the staples. That's the that's your Sheng Xiong groups. Yeah, food, exactly. Wilmar, which has also been quite strong this year, and Sheng Xiong Group as well has been obviously a very strong stock. I think it was ranked number 66 by turnover last year, and this year it is ranked even higher, number 48. So it's in a top 50 stocks by turnover this year, Sheng Xiong Group. And it's reported almost 100% year-on-year growth in its first half of 2020 net profit. But it's still, you can see there's competition out there that not just in the brick and mortar food grocery stores, but also in the online players as well. And yeah, I think it's become a more relevant stock market play this year. And as you can see, it's moved from a top 70 stock by turnover last year to a top 50 stock this year. But where you can see the weaknesses is I guess in banks, energy stocks, passenger transportation, and so forth, and also a big difference, as there has been over the last few years, of the S&P 500 index and the S&P 500 equally weighted index, because as we said, much of the strength in Wall Street as well as the FTSE All World Index is the fact that 2/5 of that index is tech and healthcare, and as it gets bigger and bigger, as you were talking about, Apple today being the $2 trillion company, as these stocks get bigger and bigger, their weighting gets bigger. So I think it's actually closer to 45% now weighting in the S&P 500. Yeah, for the whole health and telcare thing. So anyway, so I've got the next slide, which is the Singapore stocks with the high tech sector exposure, and you can see there, in the first half of 2020, our tech stocks pretty much continued their strong performance from last year. So tech stocks have been, all across the world. Back in the beginning of 2016, there was a re-rating on global tech stocks, Industry 4, 5G coming on and so forth. And ever since then, there has been a gradual gain. Last year, our 5 big tech stocks, Keppel DC REIT, Mapletree Industrial Trust, AEM Holdings, UMS Holdings, and Netlink averaged 77% gains last year, and they're up 18% this year. And again, or 18% in the first half of this year. I think even more now. Key thing is that this is a global trend, and this is not just what we're seeing in Singapore. You look at the 30 biggest stocks across the world. Not the Dow Jones, but the 30 biggest across the world. So that's including your TSMC and your Samsung and whatnot. Your 30 biggest stocks, they now include 14 tech stocks that have also kind of consumer-facing businesses as well. 10 years ago, it was only 6. So that's grown significantly, and that's created obviously a lot of the returns. But there is a lot in those tech stocks. Then it's one sector, but you've got all sorts of sub themes that are really relevant, and they're relevant to a lot of our tech stocks, as you can see in the annual reports as well as the half yearlies. You've got things like cybersecurity, e-commerce, robotics, automation, 5G networks, co-location, digital technology, and so forth. It's become pretty interesting. I think top quartile of global tech stocks, we saw those returns, but they generally trade with a PE ratio around 40 times as well. So that's one thing to watch as well. Obviously, as you were saying, JP, you don't have a PE to gold, you don't have dividends of gold, but PE ratios can sometimes be a filter that you can apply to stocks when you're looking at thinking whether they're too overbought or not. Yeah.
Well, here's my question, Geoff. That's a very, very helpful metric there. There is an argument though now that because earnings have been so dismal, and expectedly so because of how deep the downturn is it still a valid valuation metric to use in this day and age because of just how bad it is? And should we maybe consider other valuation metrics, and what other ones can we use to perhaps just identify if a stock's pricey or if a stock has quality or what? I mean, there are alternatives to PE ratios, right?
Yeah, there are, and particularly I guess a key ratio for the banks, and as I said, there's been a lot of convergence of banks across the world, is return on equity. It's a broad indicator of the bank's ability to generate some income. And you look at the top quartile of the global banks in the first half of this year, they generated a median decline of 21%. But the global bank stocks with a ROE, or return on equity ratio, of more than 12%, saw a lesser decline of around 15%. So the top quartile was down 21%. Banks with an ROE of 12% or higher were down less, a median decline of 15%. If the banks had an ROE below 8, they saw a stronger decline. They were down 24%. And if the banks had an ROE of less than 4%, so a really low ROE, their median decline was 28%. So there it is. You've got ROEs at 12% or higher for global banks, median decline at 15%, ROEs less than 4%, median decline was 28%, almost twice as much. So ROE is one for the banks. Basically a lot of every sector kind of has its own intrinsic metrics or financials and valuation indicators. Debt to asset is obviously really important for real estate. So much so that back in that first half, global real estate stocks, I think they were down around 16%. 16%. And going into 2020, our 10 real estate stocks in the SDI, they generally had a lower debt to asset ratio. I think it was around 31% coming into this year, which was less than, yes, I don't think I have a slide on this one. Sorry. Probably should. It would probably make it a bit clearer what I'm trying to say. But basically, the higher the debt to asset ratio, the worst performer the real estate stocks have been this year. So our SDI stocks, they have a debt to asset ratio which is closer to 30% versus the top quartile of global real estate stocks, which is closer to 40%. And just look at just hear me out on this in terms of how important this metric is for the real estate stocks. Global real estate stocks with a debt to asset ratio of less than 20%. In their last FY saw a lesser median decline of 9%. So it should have been down 16%, but debt to asset ratios less than 20% across the world saw a median decline of 9%. Stocks that had a debt to asset ratio of less than 10%, so very little debt to their assets, actually saw a small median gain. And stocks with a debt to asset ratio above 40% were down around 20%. This is important to do some homework on, and we've got this on our stock screener as well, on the SGX too. We do provide these.
I do use that stuff. Good. Yeah.
Oh, good.
I think it's. I do want to stay on that point too, Geoff, because it's not just an important metric. I think it's a very special metric in these times. What many people are worried about now is, while there's all this uncertainty, the question is how many businesses can hold out, how many businesses can actually withstand this, the downturn and the headwinds and the uncertainties in their industries. Can you stay alive? And one of the ways you're going to have to look at it is, some people call this the quality of your assets. Well, if you're a company and you have less debt to worry about in these environments, then that's one less headache for you. Whether you're a mom and pop shop or you're a big conglomerate that employs 40,000 people, that's just one less headache. But if you have to worry about these debt payments and interest payments, and there suddenly becomes a problem, can I meet my debt issues? That could be an actual issue, not just based on what your company can actually do moving forward, or whether or not it can meet its debt problems, but it could also mean that this company might even have its own survival under threat. You might see bankruptcies moving forward. So I think these metrics that Geoff just mentioned, debt to asset, looking at your leverage, making sure that you can see how much returns your equities can bring out. I mean, it's a bit of a no-brainer. The lower the debt to asset ratio, they tend to outperform because they have less baggage or debt baggage, which is very important, I think, in this particular situation, in this pandemic, in this downturn also. I want to use that point, though, Geoff, to bring in a question from AB Terrence here, because we did talk about debts, and that ultimately brings us back to the banks. We've touched on it also. The local banks seem to be oscillating between a narrow band, but mind you, we did see them come down quite significantly a handful of times this year also. There could be some near-term factors, or I think the second part of the question is more important, if I may be bold enough to say to dub it that. Do we have to wait for better economic conditions for some of these banks to start regaining some of their luster? I mean, in some sense, also, it's just how do we evaluate banks, and what kind of risks should investors be aware of when they're evaluating whether or not to add banks to their portfolio now? Because it seems that all these credit risks, eventually they'll start to come back or funnel back to the banks, right?
Yeah, exactly. And look, all the accommodative monetary policy and economic lockdowns that we've seen, it's basically meant banks have had to very suddenly contend with a big reduction in their interest rate margins. At the same time, less demand for financing, and at the same time, boost the needs for loan provision. So, that's been the story for banks, not just in Singapore, but all across the world.
Across the world.
Yeah, exactly. But being able to generate income is really important for the banks. So digitalization efforts, the ability to cross border, such as what we've seen with our banks and growing their China revenue, I think by something like 175% in almost 10 years. Ability to be agile is a really big thing. So looking at, looking at the interest income is obviously very important, but also the non-interest income is going to be a really important factor as well.
Right. So that's So that's basically how so let's move forward, Geoff. There's more that you actually want to touch on.
Yeah. Okay. So we've got the high tech sector. I think we should probably go to the next one, which is the healthcare index, the iEdge SG Healthcare Index, because this really tells the story in terms of how the tech stocks have moved. The tech stocks, it hasn't been uniform across the whole sector. As we said, it's mostly to do with the manufacturers and the distributors of medical equipment and suppliers. And that's really moved this index up significantly. And you can see I've got the three tables at the bottom half of the slide that just show you how the weightings of these big stocks have moved. You've seen Top Glove moved from an 11% weight to a 28% weight. Riverstone Holdings was, I think it's the 9th biggest stock at the end of 2019. That's now the 2nd biggest stock with a 16% weightage. So there's a lot of movement in the index per se, but not all stocks have gained. Over the period and so forth. We've seen a few declines. We've seen various, moves by the hospitals and the traditional clinics, but it has been a pretty big part of our turnover this year as well. I think that the combined turnover of all these stocks has been between $50 million and $60 million a day in total. So it's that little green line underneath the blue line. So the blue line is showing you the reaction of the index and how the index has moved from March 2020 all the way through to August. But at the same time, the green line underneath is just showing you the investor participation growing significantly as well in these stocks. It's important for us as well to let the market know exactly where the stocks were. What stocks we've had. We've had a lot of these companies that, like Top Glove Corporation, for instance. It didn't have much turnover. It was a top 500 stock by turnover in 2019, and it's just outside the top 50 by turnover this year. But at the same time, investors know the stock, obviously, because it is based in Malaysia and it's the biggest manufacturer of the nitrile gloves globally now. But also the executive director, Chong Guan Lim, has been down here a lot, talking to institutional investors as well as retail investors, and doing a lot of significant investor relations work here. Back when they could, in the auditoriums and so forth. So it can take some time to build a case for investing in the stocks, for instance, and it can be existential exogenous factors as well. But as we've seen, nonetheless, there's a lot in our healthcare sector per se. As we say, there's 30 stocks. If you look at the top the top. I'll have a look at the top turnover stocks. Medtex has been the top one. Riverstone, top glove. But then Biolytics as well has been in the top 60. Hyphens Pharma, First REIT, and Trendlines. There's quite a lot of stocks that have been traded significantly this year versus last year. And then, but at the same time, if you look at the next slide, you can see gold as well has been moving up significantly as well, and you can see that volumes tripled somewhat. So I mean that's pretty much from just sharing the slides. That's pretty much what I've got, JP. I think if investors want to see some more charts and go through some reports and so forth, we do have an investor resource page, which is the next slide, and there's a QR code that investors can simply go and scan that QR code, and then there'll be a heap more reports and whatnots.
Well, here's an interesting question Johnny Yap brings up at the end here, Geoff, since we came off of these medical, the healthcare sector also. He has asked about the performance of Parkway Life and Raffles Medical Group. They're both in healthcare, but apparently the performance differed substantially. For me, I think the interesting thing is that you'd think that in a pandemic, all healthcare stocks might perform well because there's a demand for it, but that doesn't seem to be the case. There are a couple of healthcare offers that seem to be lagging others, and just shows that no two healthcare stocks seem to be created equally, right?
Yeah, I mean, but Parkway Life and Raffles Medical, Parkway Life's seen around 1.2 million of net institutional inflow, where Raffles has seen outflows around 2.6 million. But that's the thing too. The very different performances. I think year to date, Parkway Life's up 10% in total return. Raffles is down around 18%. So it's interesting too. If you were to, there's probably investors who are invested in both because they might, unless you do your homework. This is why handfuls of stocks or trios of stocks or duos of stocks can be useful, because as you said, you might envisage that the challenges of the COVID-19 would mean that most stocks would see more interest, but sometimes you need to kind of spread the net, and maybe have equal exposure to both. If you did have equal exposure to both, you'd be looking at a very marginal decline in the year to date, and obviously clearly beating the benchmark as well.
Yeah, right.
But for the financials and so forth, to compare them both, so they're both for the both financial reports, you can obtain that from our company announcement page on the SGX website, and pull the numbers there, and usually as we've seen in the market, there are economic reasons for their performances.
Mm-hmm. Okay. So, Geoff, we've used the word homework a number of times in this discussion. Doing your homework is important. I think this is something we've all learned since we've been hearing this since we were 5, 6 years old. Sometimes we follow, sometimes we don't. For an investor who's getting into the markets and saying, "Okay, I get it. I have to do my homework." How does one do effective homework when they're actually looking at a stock? Do you have any tips, or perhaps just like a bit of a blueprint for folks who want to figure out how best to do homework when they're investing?
Yeah, I mean, everyone's got their own style, right? I mean, some people might like reading a book, some people might wanting to watch the the YouTubes and so forth. But I've always found what we've been doing, where we've been most effective with the investors over the last few years, maybe last 9 years, is that that's
not a few, by the way, but go on.
It's not a few, but this is the way the industry types of works. In that you can have the reports, you can have the analyst reports, you can have the educational reports that we produce at SGX. you know, the theory, but you also need the engagement. You also need the engagement as well. So you need it's the presentations or the programs and the podcasts and the one-to-ones are a big part of that as well. There's always two sides to the coin. One is the reading and the writing, but the other is also getting to know the company, getting to know the this is why why so many investors cherish the AGMs, getting to see what the board, how the board handle the big questions. Not just you read the annual report and that's great, but it's also good to go to the AGM and see what the board have to say, and you have that engagement as part of the process to complete your, I guess, holistic view on the company. But whether it's financials, there's also technical analysis and also keeping in touch with your brokers and remisers and enjoying it, basically. Which investors should do, because we have a great market here, very diversified market, very nice market that has a good focus on Singapore, but as well as a lot of focus on a lot of Singapore's successes with international countries, and having a lot of companies that have exposure to Southeast Asia, to Greater China, and obviously, real estate is a big thing in Singapore. We have fantastic infrastructure. We have fantastic residential HDB program that's a cornerstone for our successes in the real estate market. And that transcends into our stock market as well. If you look at the big global real estate indices, the EPRA Nareit real estate indices, you've got, I think it's more than 5% of your choices when it comes to all those stocks are actually listed here in Singapore. So we punch well above our weight in having a lot of global international real estate stocks here that are not just Singapore focused, but focused across the region and indeed the world.
Okay, so here's maybe we can try to humor and include this older question from Ken Ernest a while ago, using that framework about doing your homework, right? I know just comment on that. So, I mean, one of the telling things that Warren Buffett used to say, and it might make it sound very boring, is that one of the things he loves to read are annual reports. He would sit down and just pour from top to bottom an annual report of a company just to get to know them. Now that takes a lot of time. It might also be very dry, but that's one good way if you have a free afternoon to really get to know a company and really understand that. But you also have to be able to pick out whether or not there might be some issues and some question marks over what they're presenting. Also, there are many ways you can get to understand a company, and I do want to use this also. I mean, it's difficult to talk about. I'm a bit averse calling out one particular company and saying let's dissect it. But if we were to do our homework, for instance, on Sembcorp Marine, and Ken's got some very interesting, very pointed questions here about where do we see this industry heading forward, all that. But the way you can do that and figure this out is you have to do your homework. So if we were to do our homework on this particular company and ascertain, is this something to get into or not, how would we go about it? Like the methodology of perhaps, what would you do first, Geoff, if you saw Sembcorp Marine on your table and you wanted to do the homework to understand this and understand some of those issues that Ken Ernest brought up? How would you go about it, like a step 1, 2, 3, maybe?
Well, half of it's financials. Half of it's fundamental analysis. Okay, looking at the financials. Okay, before we get to Sembcorp Marine, let's just go back to Raffles Medical Group and Parkway Life. So we said there was a divergence in performances. Parkway Life's up 10% year to date. Raffles Medical down around 17% year to date. But look at the revenue that Parkway Life generated in the first half of 2020. Its revenue growth was up 5%. You look at revenue growth for Raffles Medical Group over the same period of time, the first half of 2020, its revenue growth actually declined 5%. So you've you can start from there, and then of course that's in the past. So you also have to look at the outlook. Every company, when they release their half yearlies, will also have an outlook for the next 6 months or so, and that's really important too, because once you've got once you can see where your company is headed, what your company sees as the opportunities and challenges, you're able to assess them. You're able to take that, apply it, listening, reading the market, and seeing what lies ahead per se. I mean, that's kind of pretty much what you do as well in your role, right, JP? That's when you're going through the numbers, when we're having in the company's report and so forth. I've heard you a few times. You go to that level. I mean, and that's pretty much the way to start. And that's, of course, doing your homework. And by homework, I'm saying this is work you do yourself. It's also really important to keep in touch with your broker and your advisor and so forth.
Mm-hmm. All right. Okay. And let's see. Alison Nung here, Geoff, has a question. Do we have any slides right now showing how Singapore's banks are performing at the moment? If we don't have any slides, I believe that they're still fairly deep in the red, I think, year to date. Not to say that they are in trouble or anything like that, but the stock is definitely, and mind you, it's not just the banks here in Singapore. I believe some of the banks in the US have also been underperforming for quite some time, and I think it's also because of all that uncertainty. How much potential bad loan provisions are all of these banks going to have to prepare for moving forward? I think this is what's keeping a lot of folks maybe on the back foot. I think with the banks, it's not so much that they're not cashed up or they can't handle it, but it's a question of how many rounds are they going to have to go through before they start to see a little bit more easing pressure. I think that's also why some of the banking stocks have been a little bit more subdued vis-a-vis some of their contemporaries here, at least.
Yeah, totally. But it's all been very aligned. They've been so the moves of our three banks as a trio, when you look at the average returns, have been so similar to what we've seen across the world. In the banking sector, almost matching it on a week-to-week basis. But these banks, they have a good history. That if you look in terms of the performances in the last 10 years, the annualized average total returns of our trio of banks is 6%. And we know that, as you're talking about provisions and so forth, these are three of the three safest banks in Asia, according to Global Finance magazine, and that's taking ratings from Moody's, Standard & Poor's, as well as Fitch. I think they rank. I know they rank very highly on a global basis as well. But looking ahead, as we said, ability to generate income. Keeping tier 1 capital high, which is I think predominantly pretty high, and also growing income, being able to grow income that's outside of the interest realm, and we've seen them, as I said, combined Greater China income was 2.3 billion in 2010, and up to 6.4 billion last year. And of course we had the dividend cap as well. That's to bolster their ability to basically support whatever credit needs that businesses and consumers will have in the upcoming future. But I will say that the three banks actually did rank very highly as well in this index we call the FTSE Developed Asia Pacific ex-Japan Sustainable Yield Index. That was basically looking at the financial and the operating strength and the ability to be able to generate cash flow and pay high dividends. Those three banks were amongst the top 10 constituents as well. But at the same time, quarterly net interest income has been growing gradually. I think it crossed the 4 billion level in 4 billion mark combined in the fourth quarter of 2014, and then above 5 billion in the second quarter of 2018, and it still came in above 5 billion just for the last quarter. So, but again, it depends on.
I think the other thing I'll add about the banks too, and this is, go ahead.
Sorry, I mean.
Oh, go ahead, Jeff. No, sorry.
Yeah. No, I mean, but again, we really are in this together, literally, because we will know when when we can start seeing things return to more normalization, is when you expect to see much of these sectors, such as transportation, such as I guess the consumer discretionary type of businesses, the global banks and so forth. So there's a lot, there are a lot big kind of cyclical factors here.
Right. The one thing I will add about the banks too, and I think Geoff highlighted a lot of metrics that actually point that they're on very solid ground. But when you look at a stock also, or when you look at a company, it might be as important to know, well, where are they heading and what are they doing? One of the facets that they highlighted when it came to some of the Singapore's banks, and and the reason they were ranked so highly, and they've always said it's because they are among the most advanced banks in the world in terms of adopting digital practices and digitization. We have seen that the pandemic itself has pretty much accelerated a move towards technology, which is why you've seen data centers rise, because the more digital things have become, the more you're going to need storage, the more you're going to need data processors, servers, microchips are back up. Who would have thought that Intel, which we thought at the start of 2019 was going to start wobbling and fall of the count, suddenly gets a boost and suddenly lifts AEM with it, for instance. The banks, going back to the banks, a lot of them are being lauded for being among those at the forefront of digitization. If this pandemic continues and you start to see a real permanent shift towards digitalization, instead of being 30 years from now where we make that shift, it might be 10 years from now. And because of the efforts that some of these banks have put in, this could put them at pole position to at least weather some of those storms. There are so many people that are trying to challenge banks in terms of digitalization. You've seen the rush for digital banking licenses in Singapore alone. But but it's also been said that the banks here, because of the capital base, because they've spent enough time to at least look forward and say, okay, digitalization, we've got to prepare for it. They might be among the most prepared banks to weather those changes and even come out as possible leaders in that space. So Geoff outlined there what makes them strong, but you also look at where the banks might be trying to head. And I think this also plays into the analysis of, is going to apply to any stock, any particular sector. Look at what they're standing on and look at where they're trying to drive towards or move towards, right?
And digitalization enables the banks to do their business. Look at so for instance, in the prospects in the outlook that Sembcorp Marine gave when it reported its first half 2020 numbers, and I'll quote them. They said, Sembcorp Marine is gradually resuming project executions safely and progressively. How soon the group's workforce will be allowed to return to full strength will determine the business outlook in subsequent quarters. So again, it's resumption, normalization, gradual reduction of the lockdowns, and so forth that are a really big factor in many of these sectors, which is the same as we say across the various sectors around the world. The same challenge, and it's why we look at the numbers, and it's why you're starting the news every day, JP, with COVID developments. Yeah.
Right, because you also have to take into account you have the numbers, but the numbers are, and the fundamentals of that company, their debt levels, their cash flows, and all of that, it all can't exist in a vacuum, right? It all has to exist against the context. So when you evaluate, for instance, this is one very often used example right now, and very apt example is Singapore Airlines. Very, very strong company, very, very strong balance sheet pre-COVID, but everybody is pretty much gotten whacked by this. it's not their fault that 96% of their fleets have been grounded, but have they taken the steps to actually address and say, look, I've got all these fixed costs and I've got to make sure that I can stay afloat, hence the rights rate, or the rights offer, hence the fact that they need to raise cash moving forward, and how they're going to prepare themselves is going to be important. When we talk about Sembcorp Marine, some of the uncertainties that they'll have to prepare for, when you look at what's in their balance sheet and how strong that is how are they going to weather the uncertainty with regards to oil markets, the demand for some of these platforms? Yes, also, and it's almost impossible for them to determine when their workforce can come back, because it's a question of when the virus is going to let them. But
that's also and that's why the job support scheme
and make sure they don't say again. It's a question of, okay, we don't know how many more low coming up. Yeah, we didn't catch that bit. I didn't catch that.
Yeah. Sorry. Yeah, it's something a little bit wrong with the connection. But yeah, that you see this tiering, the job support scheme.
Okay, I think
so the job support scheme has the 50% wage support being extended to March 2021 for those aerospace and the aviation, the tourism industries, and I think it's 30% wage support for marine and offshore and retail and land transport and so forth through to March 2021. So. You're right in terms of that's the weak points, and that's why a lot of the government measures have to be very structured and specific now and focused on these industries. Because biomedical services, financial services, ICT, and so forth is obviously a strong point of our economy. And you remember the NODX reports as well. We saw biomedical was a strength there. So that's why, hence, we're getting these targeted structural type of policies that are really supporting the industries that really need it.
Yeah. Yes. So, Geoff, I think we're down to the last 5-6 minutes. I will encourage people to ask maybe one more question if you'd like, but I think we have to slowly start to wrap up. I do want to ask you, Geoff, if there's 2 or 3 things that you think people who are investing in the stock market need to keep in mind. What do you think those things should be? Whether it's to answer the question of should I go into the markets or not, or how do I conduct myself better when I'm trying to construct my portfolio, making sure that I'm making better or more sound decisions. What are 2 or 3 things that people maybe need to keep in mind when they go about their daily life in the markets, or in the stock market specifically?
Well, it's up to what the investor wants. What is the investor's risk profile first and foremost, and what does the investor want out of the market? What are they looking for? Are they looking for investing over a long period of time? If they are, there's specific ways and markets to do that, and they're pretty simple. It's exchange traded funds that track indices. Indices like the Straits Times Index here in Singapore will always represent the biggest and the most traded stocks here in Singapore. So much so that if you look back since 2014, we've had 10 stocks actually come into the STI. Okay, a few were with increased liquidity provision, but your index should always provide your biggest and your best of your stock market, which should have a lot of relevance to your economy. And I think that's pretty much what we've got here. Your STI in Singapore, it's 53 years old. It basically has its beginnings as of the end of 1966, thanks to the Straits Times newspaper, and it's generated average annualized returns of around 6% a year in terms of price ever since it started on day one. Now the thing is, it's only been investable since 2002, with the first ETF launched on it in April 2002, and then again another one in February 2009. But it's investable now, that index, and that can be a general good way for an investor to start. And then you've got to work out the timing as well. You don't necessarily want to go and put all the eggs in one basket at one period of time. You might want to spread it out over a few, over a fixed amount of time, so that you can have that dollar cost averaging aspect, and reduce that timing risk. You've also got other markets you can use the ETFs for, your bonds and ETFs and bonds and gold and so forth, or other international indices. So there's a lot of choice, I guess, when the investor looks at the market. There's also a lot of companies that we have here that are household names and well known, and obviously good investor relations. You can always type in the name of the company in Google and then type investor relations next to it, and it should take you to the investor relations page of the company. And that can obviously act as a good window or a good conduit for you to understand the business better. And you can actually see in some presentations that many of these companies that we have listed here are very passionate about their investor relations, and that's their relations with you as an investor. Unfortunately, we don't have the face-to-face gatherings that many of these listed companies really enjoy doing, particularly with individual investors. But that will resume obviously someday. But in the meantime, I'm sure there are digital events and so forth to keep informed. And obviously, the Money FM radio as well do have a lot of our brokers, our market participants, our issuers, our listed companies and so forth do come onto the program quite regularly, and it can be a really good source of information as well. So, I wouldn't say the world's the oyster, but there is a lot here. There are a lot of good resources here in Singapore. It's financial services is a strong point of this economy, and I think investors can be well served if they do want to get more involved in the investing and the trading world here.
Geoff, can I ask you one last very quick favor before we wrap up? This has been very informative in sort of setting expectations, perhaps just approaching things. But I do think that perhaps we can flash that other slide about where the XGX Academy is, if people want to sign up for the courses of the SGX. I know you showed the little bar, the little QR code as well, and where people can sign up. So I think this is also very interesting because it's a wellspring of material that the SGX has compiled over time. And if you have questions, if you want, and these tips, these particular techniques that you might be able to employ. I mean, Geoff probably knows this stuff, and you probably recite this in his sleep. What's inside the SGX Academy. But I would implore folks that if you want to take your change a little bit further, if you want to get more in depth into it, also, so you have the tools to really approach investing. Also, I think you just take your tools from wherever you think you can get them, and if you think they can help you, they're there. And I think there are fewer. I can't think of a lot of places or a lot of wells that might have this much information for you folks. But the SGXacademy.com, Geoff, is there anything you want to add about it?
Yeah, the Telegram channel's the newest, I guess, content product that we have, which we love. So I hope you're on Are you on Telegram?
I am on Telegram, actually, Geoff. Yes.
Because you're also on our SGX Telegram every Friday as well. We do post the podcast of the weekly wrap. So it's a great way to keep in touch with investors, and it's great also for investors to also keep in contact with us and let us know how we can help in terms of serving them with either content or events, engagements, and obviously help them so that they can have the right information to make the best decision or the most informed decision possible when it comes to it.
And remember, this brings us back to that disclaimer, right? It's what's best for your investment decisions and best for your risk sentiment. Also, only you guys know that. It's good also to understand what you're looking for. It might take some time to figure out what you're actually looking for when you're setting up your investment and figure out what your investment objectives are. But always know that there are resources out there. There is information out there for you to use to become better at this, to make better informed decisions also. And I just implore you folks to just keep on the journey, actually. And folks like Geoff and myself are here. I'll ask more questions. Geoff will provide more answers. That's what we can provide, what we can guarantee. But and I, on that note, I would like to first and foremost thank Geoff again. Yeah, Geoff, I'm surprised that you're still not sick of my voice, given we speak like every Friday for about 15 minutes. But I really want to say thank you for. Yeah, I do want to say.
And I listen.
Absolutely.
I'll listen throughout the afternoon.
Absolutely, and we appreciate that. But we also appreciate you spending some time in imparting some knowledge, and also imparting some of your experience for our listeners, for our viewers here on Money FM 89.3. And I'd like to thank everybody for making some time to join us today on Money Matters. This is going to be a moving conversation. I would like to remind folks also that if you would like to see this again, that you can rewatch previous sessions, not just of this episode, but also previous episodes with Michelle Martin and Gabriel Yap with regards to S-REITs, with Ryan Wang and Don Sher about setting up an investment portfolio for parents and for their children. This is all going to be available on our Facebook page, which you're all familiar with at the moment. You just have to find it if you want to rewatch these webinars. But we do ask that you like and share the video if you do watch it with anybody else who wants to learn the basics about the stock market, the basics about investing, and just get even better ideas about how to approach things, right? Of course, you can always listen to Prime Time on Money FM 89.3. The content throughout the day is always tailored to us, helping you make better investment decisions and to make sure that you're up to date with the environment in which you're making those decisions in as well. Market View every day. Geoff, myself, and Clarissa Montero always speak on every Friday about 1:50, and we usually have these kinds of conversations that pretty much just go freewheeling about what's going on in the markets. Very similar to this, maybe just a little bit more abridged. And and please, on our Facebook page, please tell us what kind of topics you want to hear from us, what topics you'd like to know more about, and we will see if we can bring that to you, because ultimately this is your education. This is what we want to do for you folks. Also remember that we want to hear from you, the feedback in the comment section, and we're going to pick 3 lucky winners who might win an exclusive Money FM 89.3 goodie bag. Honestly, Ashkin's the only one who knows what's in that. I don't know what's in it, but it doesn't hurt to have a goodie bag at these times, right? So without further ado, I just wanted to say thank you again to everybody for joining us today, and really appreciate you guys taking some time out of your schedule. You could have been anywhere else in Singapore, but you're here with us, and I really appreciate that, in the words of Jay-Z. Have a great night, everybody, and we look forward to seeing you again on Money Matters. And Geoff, as always
thank
gratitude for having you on the show. Yes, sir.
Thank you so much. Thank you. Thank you very much.
Thanks, guys.